And today I'm going to give you a brief tutorial on how currency movements can influence the sales and profits of a company. So just two very basic consequences of currency movement. When a country weakens their currency, it can make their goods and services cheaper to foreign markets. And on the flip side, a stronger currency makes it more expensive to buy products and services from that particular country. We're going to give you an example of that in a moment. And secondly, most companies that are floated on stock markets are global, but they report their profits in their local currency. And when a currency is weakened, companies which report in that currency benefit when they're bringing their profits back from other currencies into their local currency and vice versa. We're going to give you examples of that now. So let me take a very personal example. And this is January 2014 when I'm recording this. The euro dollar has weakened substantially, and I'm going to give you an example of how that has impacted me personally. So I live in Ireland. I love visiting Florida, and in particular Orlando. When I started going to Florida years ago, the exchange rate was 137. What did that mean? Well, for every euro I exchanged into US dollars, I got $1.37. So if I changed €1,000, I got to spend $1,370 in Florida. But now in 2014, the exchange rate is 112. What does that mean? I only get $1,120 to spend for my €1,000. So this has an impact of making US goods and services more expensive to me than it was a number of years ago. This can have a negative impact on sales and profits of a company, because now that I have less dollars to spend over there, I'm not going to be able to buy as much with my $1,120. On the flip side, Eurozone goods and services have now become cheaper. So people coming from the US over to Europe can now buy more, which means that the demand for products and services in Europe should go up. Another example is when we're talking about company repatriating their profits. So let's pretend we have a company called Widgets Incorporated based in the US. They report their profits in their local currency, which is US dollars. Now let's pretend they made $100,000 profit in the US and they also have a market in Europe which they made €50,000. If we say the exchange rate for the euro dollar at the time is 130, this means that the €50,000 profit in Europe converted into US dollars is €50,000 multiplied by 1.3 gives you $65,000. That means total profit is $165,000 for Widgets Incorporated. But if we used an example where the euro dollar weakened to 110, the €50,000 profit is now only worth $55,000. This means that the currency movement alone has cost this company $10,000 in profit. On the flip side, if the euro or the US dollar strengthens to 140, then the US profits would increase to $70,000. So as you can see from here, currency movements have a major impact on profitabilities of a company. So a couple of things you need to take away from this, right? In relation to the repatriation of profits. So this is where companies, when they're reporting their profits, they're bringing back their profits from other geographies, other currencies. Most of these multinationals have what they call treasury departments. Their job is actually to hedge this currency risk. They also hedge other risks such as fuel costs and food costs. So most of the time, a lot of this currency exposure is hedged away in terms of repatriating profits. But not in all cases, and in particular recently when we had the euro weaken so quickly, I would suggest that a lot of currency risk wasn't hedged. And that will have a knock-on impact when it comes to those companies reporting earnings. So you need to be aware of that. But in relation to goods and services, this will have a negative impact because really when a country kind of strengthens their currency, their goods and services become less attractive because they're now more expensive, as I've just previously demonstrated. But on the flip side, when a currency weakens, now their goods and services are actually becoming cheaper to foreign investors or foreign purchasers, and demand should increase. So when you're investing, you need to look at currency impacts when you invest in a company, especially around the earnings season. You need to know how much a company profits come from foreign currencies. So if you take a company like Pfizer, for example, they sell their products all over the world, but they report in US dollars. So you need to know if the US dollar is strengthening, how much of their profits that they're going to be bringing back into US dollars may be affected by currency impacts. So remember, a weakening currency will have positive impact on stock prices. A strengthening currency can have a negative impact on stock prices. Okay, so that's a very brief tutorial on how currency can affect share prices. Why don't you learn with us? We will train you to manage €50,000 of our money in the stock market risk-free for you. So you will learn with our money how to manage a portfolio in the stock market. My name is Stephen Cox. This is Share Navigator. Please contact us. Visit our website if you'd like to know more. Thanks and bye for now.